excited here, talking about taxes.
I love taxes. Most people don't, but that's why I do what I do. I'm going to be strategically harvesting money and putting them into buckets so that long term I'm paying the least amount of tax possible, right? Goal isn't always pay the least amount of tax now, it's pay the least amount over my lifetime.
Hello everyone, welcome to Financial Clarity for Doctors. I'm Rochelle Vander Zanden here as always with my co-host Corey Janoff.
Hey there.
Yep, we're here to talk about taxes, very exciting. We actually have a special guest today. It's Ryan Kramer. Say hi, Ryan.
Hello.
Yeah, he's part of our Finity Tax division and he works with a lot of our clients. Specifically, he works with a lot of business owners and also people that kind of have high net worth. And this information, we're going to try to get it out to you just for informational purposes so you guys have some little helpful tidbits. But if you do need specific advice for your plan, please reach out to a tax professional that can actually help you with those specifics. This is not that. Without further ado, let's get started a little bit.
Yes, thanks for joining us, Ryan.
Thank you for having me.
Yeah, excited here, talking about taxes.
I love taxes. Most people don't, but that's why I do what I do.
It's a good thing.
It's a good thing.
Yeah. So I guess, it's tax season right now. Maybe let's dive right into it. What are some things that doctors and I guess anyone in general should do as they approach tax day?
So I'm going to start that with, you should have had a plan in place back in January. And if you didn't, then you'll want to come up with a plan for next year now. For the most part, you can't do anything. We can't go back and add to the 401k, 403b. It's past us. Now, there are other avenues of opportunity. So, for example, if you've not funded a backdoor Roth contribution conversion, we still have until April 15th of 2020 to do so. If you had planned on making charitable contributions, you still have until December 31st to do so. If you've got a pile in your garage of Goodwill, just get that down there, get the receipt. Biggest thing is documentation. Right? If you don't know about it, if you didn't document it, then your CPA or your tax software or whatever you do, if you don't have good books and records or a good system to capture all of that information, it's lost forever. So that would be my recommendation: is stay organized. If you're not organized, go back and get organized. Talk to your financial planner. Talk to your CPA and make it happen.
So really, 2019 is behind us, but now is when you can start coming up with a plan for 2020.
2019 is behind us because today it's 2019, but when this is published, it'll be 2020.
Yes, so plan to have the same on your 2020 taxes.
On your 2020 taxes. Don't have this same problem on December 2020. So if you're maybe listening to this a couple months before April 15th or after April 15th, right, there's nothing you can do. But it's essentially that backdoor Roth is about your last opportunity of benefit. Could be that you might have health savings account amounts that you haven't fully funded. You'll have until April 15th to get that fully funded as well. So a few tax deductible avenues. Some states have the 529 plans that can get funded until the due date of the tax return in your state, and it just depends on is there a deduction in your state and should you fund it, right?
So I guess that would lead to the natural next question of, if last year is behind us, we can't really do anything to help our taxes this coming April, but what are some steps people should take looking ahead throughout this year to help better position themselves for tax savings next year?
Yeah, and it really depends on what your income sources are, right?
Mm-hmm.
So let's just take as an example, if all you've got is W-2 income. A little bit later we can jump into, okay, well, we've got W-2 income, what if we have other sources of income? What are the opportunities that we can take advantage of? And if you have W-2 and that's it, then we're looking at for any of our clients, we're looking at the order of operations for tax savings. And what I mean by that is we look at your marginal tax rate and do we choose, depending on income, typically, in general, it's if we're over $315,000 in taxable, that's federal marginal income tax rate, approximately $315 married filing joint. We're looking at a 24% marginal tax rate, right? And the kind of point of apathy for me, whether I'm going to make a recommendation for pre-tax or post-tax dollars, is going to be that 25% combined federal state income tax rates. Now, there are as with any answer in tax, it's always going to be it depends, and it really we look at both the client and their long-term plan and the short-term plan. So my answer could vary from one person to the next just because of a slight tweak in facts and circumstances. But in general, we're going to go with 25% point of apathy. So if you're making more than that amount, if you have a higher marginal tax rate, then we're going to dump all the money that we can into pre-tax dollars. So we're maxing out the 401k or 403b. In addition, if you have access to a 457, we're maxing that out as well. Really, it's important to speak with the HR department, talk with your financial planner who can help analyze benefits. If they do that, and go in and say, okay, here are my pre-tax options. I have these potential benefits. What can I utilize and what should I utilize, right? Just because you can do something doesn't mean that you should do something. There are many flex spending accounts, for example, where it's a use it or lose it. Well, yeah, you got a tax deduction and you didn't use any of it. That's completely worthless.
You just lost your money.
Yeah, we just threw away $1 to save 25 cents. Oh, I did so good. You didn't do so good. You made a mistake, right? And I have seen clients do that, or say, okay, I'm going to give so much money away because I'm going to get such good tax deductions.
The charity you're talking about?
Yeah, it's a charity. So at that point, it's like, okay, well, what I want you to do is to pretend like you're not going to get a tax deduction when you give the money away, and just give what you would give away from the goodness of your heart, right? Mm-hmm. What makes you feel good, right? If you're going to do it for a tax strategy, it's a very poor tax strategy, right? We're not going to throw away $1 or give away $1 to save 25, 35, 45, 50 cents. I'd rather have that 55 cents left in my pocket, even if I'm at a marginal tax rate of 65%, which there are some circumstances where that marginal tax rate will be 65%. Sometimes I'd still rather have that 35 cents than to spend money on something that I don't need, right?
So with charities, like with the new tax laws, is everyone eligible to deduct charitable contributions, or is it only if you itemize?
It's only if you itemize, correct. So
you may not be able to get a tax deduction.
You might not even be able to. You might just be giving away money thinking you're getting a tax benefit because it's quote unquote tax deductible. Well, guess what? It's not actually tax deductible for you, right? It's tax deductible, but you're receiving no tax benefit. So
can you give an example of someone that would itemize?
Yeah, so in general, you're going to own a house, mm-hmm. right? Because let's go, all the numbers that I'm going to give are going to be married, filing, joint. In general, let's just assume that if you are single or married, filing, separate, then these numbers are going to be about half as much, right? So mm-hmm. married, filing, joint, around $24,000 standard deduction. So how do you get there? Well, if you own a house, you have mortgage interest, right? Mm-hmm. And that's maybe $15,000. You're going to have state income taxes and property taxes. However, those are limited to $10,000 total. So that puts us up to $25,000. Well, great, I've got this house, I've got property taxes, I've got income taxes, and I get about $1,000 of marginal benefit from having that. So the old theory that owning a house produces great tax savings no longer exists unless you have $1 million mortgage and a high interest rate. But that would suck, right? Maybe not the $1 million mortgage if you can afford it, but the high interest rate, right? Even on a $1 million mortgage, yeah, we might have 30 grand of interest, but we don't get to deduct it all, right? Because I'm going to say, okay, with that dollars, I'm going to trace that back to the standard deduction. You only got $6,000 net benefit, right? So, number one, own a house in general.
But don't buy a house just because you might be able to save a couple bucks in taxes. The house will cost you more than you'll save in taxes.
Way more, just like kids.
Agreed.
So next on top of that, then we look at, okay, once you've exceeded that threshold, then what are the marginal benefits? That's when you actually start to get a a true benefit from charitable contributions. Because if you already own a house, you already own a house. You're already getting that mortgage interest deduction. You're already getting that property tax deduction. You're already getting either the general sales tax deduction or the income tax deduction, right? So if we're already getting that, then we could look at, okay, what is my charitable contribution, the benefit from that charitable contribution going to be? And then it goes, okay, give out of the goodness of your heart unless you're considering a major donation. And then it is critical, important to consider the tax implications, because that should be part of that year's tax strategy, right? Absolutely should be. There are also strategies where you can bunch the charitable contributions every other year. Say, okay, I'm going to save up all my charitable contributions for 2019 and 2020, and I'm going to donate them all in 2020, right? Every 2-year period, you're consolidating those into 1 year, right? And that has the impact of, okay, that charitable deduction is higher, and maybe that puts you into above the standard deduction, and you'll actually get benefit in a year that you otherwise wouldn't have, right? That was more impactful back when we had a much lower standard deduction. We have these tax rules for at least the next 5 years, including the current year, so 2020 through 2025. At that point, we don't know what's going to happen, right? We're going to be addicted to the individual lower tax rates. We're going to be addicted to them, so I don't think that, what do I know, right? Congress doesn't ask me. I wish they would. I have so many good ideas that they will never implement.
Write some letters.
Yeah. So, however, for the time being, we have these incredibly, historically low marginal tax rates and wide tax brackets for lower income. I mean, this is the time where we may forego tax deductions and pay higher tax because it's the lowest that we will ever pay it. And that goes back to that order of operations for tax savings, right? So in general, depending on marginal tax rate, it goes number 1, tax deductible, number 2, tax free, number 3, taxable investments that we're dumping all money that we can save into. So if we're over that 25%, we're maxing out 401k, 403b pre-tax. If we're not, if we're below that, then we're probably going directly into Roth, and we're foregoing that tax deductible avenue, because you know what, if I make $300,000 and I only have to pay at most 24%, wow, that's pretty awesome. That'll never happen again for me, right? So these next 5 years, I'm going to be strategically harvesting money and putting them into buckets so that long term I'm paying the least amount of tax possible, right? Goal isn't always pay the least amount of tax now, it's pay the least amount over my lifetime, right? That goes with income and estate taxes. So number 2, Roth avenue. So you might be thinking, okay, what's a Roth? What's pre-tax, what's after-tax? 3 different types of money, right? Pre-tax, 401k, 403b, 457. In general, that's got a tax deduction up front, grows tax-free, comes out as ordinary income. That's a very important distinction, because all of that growth that may have been preferential tax rates, long-term cap gain qualified dividends as it's growing and spitting off dividends, long-term cap gain when you trigger that unrealized gain and convert it into realized gain, right? That's 15%, 18.8%, 23.8%, rather than ordinary income, which may be right now 37%, but has been as high as 50%, right? And it may or may not be around, but probably will, because again, we're addicted to it, right? Addicted to the long-term cap gains. So that is the ordinary income pitfall of that 401k money. The next is the Roth. It's still good money though. We still like it, right? It doesn't mean that we don't do it. We are very intentional about every action that we take.
Be prepared to pay those taxes.
Be prepared to pay those taxes. Next one is that Roth avenue, and Maybe you can make a direct Roth IRA contribution, and you can do Roth 401k contributions, or your employer may allow a mega backdoor Roth within their plan, right? And a after-tax contribution with an in-service conversion, also known as the mega backdoor Roth. I love those. Those are
So just to pause really quick for those that are, their heads are exploding right now with all this jargon. the mega backdoor Roth we're referring to. So you can do up to $19,500 this year as an employee contribution to a 401k, either pre-tax or Roth. Some employers now allow you to make additional after-tax contributions, so no tax deduction up front, but above $19,500 into a 401k or potentially 403b, and then you can actually convert those after-tax dollars into a Roth account or Roth IRA outside of the plan, potentially, if they allow it. Similar to the backdoor Roth IRA, but that's only a $6,000 limit. So
Yes.
we're potentially getting, 30 or 40,000 into a Roth account each year now with this new provision that's limited, and who can do it. It's dependent on the employer, but it's something we're
and cash
starting-
flow.
Yeah, and your
And
cash
cash
flow,
flow.
of course.
Yeah.
But we're starting to see that become more and more common.
And I think one other thing that sometimes we talk about is the same thing as after-tax and Roth, but they're not. So when you put money into an after-tax contribution, you're still taxed on that growth in retirement, correct?
Yeah,
Right,
exactly.
but if you can convert it to the Roth, then you're not taxed
You're
on the
not.
growth
So
in retirement.
yeah, that's the beauty of the Roth type money, is that
Right.
you don't get a tax deduction, but it grows tax free and it comes out tax free,
Mhm.
right? And then the investment account, it's going to grow quasi tax deferred and spit out capital gains, which we still like.
Mhm.
So as long as it's invested properly, but that's the crux of what the audience should be trying to do, is looking at, okay, if I'm in residency, how much do I realistically have to save? Not much, right? So
As much as you can.
as much as I can, and I'm gonna put it into a Roth, and that's gonna be the only bucket that I fill up, right? But as my income expands and as my income grows, when I get out of the Ponzi scheme that they call residency and into real practice, right? At that point, now I can fill up all these other buckets, and now I'm really starting to move the needle on getting towards retirement, and a very comfortable retirement where I can pick and choose which bucket of money to pull from, so I can design my taxable income and the types of income that I'm taking from, for not only myself, but for my kids or my beneficiaries, or
Mhm.
wherever my money's going.
And it gives you a lot of flexibility, because we know that tax laws will change even while you're retired, because hopefully you're retired for 30, 40 years.
Absolutely.
Right.
Tax laws will change, and that gives us that implicit flexibility. So I've got clients, just as a quick example, right now that saved at marginal tax rates of 55, 60%,
Mhm.
right? And moved to Washington, and now we're converting that income that we saved 60% on, we're converting it up to $315,000, and while we got that marginal rate of 60, we're pulling it all out, taking more than we even need in taxable income, and we're paying marginal tax rate of 24% and an effective of more like 15%. So we save 60, we're paying 15, and we're just converting 330 grand a year from 401k or now a traditional IRA or wherever it's sitting into a Roth, and it's not for them, it's for their kids, and so that their kids don't have to inherit that pre-tax account. Their kids are going to inherit that Roth account. Their kids are going to love me because I gave that advice.
Tax-free money in their lives. So.
Exactly.
Mom and Dad chose to pay taxes for you. You're welcome.
You're welcome. That's right.
And this is big, the whole flexibility of the planning ahead, because we come across, it's not uncommon that we'll talk to an accountant, and a lot of accountants are hardwired to, how do I save you the most taxes now? What
Yeah.
can I do to get you a tax deduction today? Which is great. I mean, you could argue that's their job. How do I save you the most taxes now? And that's maybe what you want. But if we're really thinking big picture, that's where Rochelle and I, as financial planners, we're not just thinking about today. What's the future look like,
Mhm.
and how can we position ourselves to potentially be better off down the road as well?
Absolutely. Absolutely.
Do you feel like there's any missteps people make, common misconceptions, anything like that? Bad advice?
So in this particular case, my answer is exactly what you said, that you should always be chasing those tax deductions. Right? I think that's, and maybe it's not bad advice, but perhaps it's misguided, or it's just not long-term thinking, right? I think not in the terms of now and next year. I think in these long time frames, right? I think in this multi-generational approach, which works for some people and doesn't work for others, because for some, depending on your unique facts and circumstances, that may or may not work. But regardless, I'll never recommend that anybody get a 12% tax deduction and put money into a 401k, especially knowing that most of the audience here is not going to be in the 12% tax rate in retirement. So it's that holistic approach that is just critical.
Do you think if someone doesn't have a Roth option in their 401k or their 403b, but they're in a very low income tax bracket, what would your advice be in that situation? Just do the Roth IRA?
Roth IRA. And
Leave it at
put
that.
everything else into a taxable account that you can save, if you can save
Yeah.
anything, if you have that source of income.
Right.
There's employer matching, obviously take that.
Right.
Take the free
Yes.
money.
Free
Take the
money
free
is
money.
good.
Free money is great. Yeah, absolutely.
I guess kind of a follow-up, we may have already touched on it, but is there any bad information out there on ways to reduce taxes that are often not in a person's best interest?
There are.
Yeah, bad advice or
I
something.
haven't run into any recently. I mean,
I know you mentioned the FSA, the flexible
the
spending
FSA,
account.
yeah,
Mhm.
yeah. Don't dump money into it if you don't have to. I mean, there's some kind of immaterial little strategies out there that just don't have a lot of meat to them, right? And it's just like they're not helpful. They don't do much, and they're more trouble than they're worth. The couple of really bad strategies are the ones that get more sophisticated, and most residents, most practicing doctors are not going to run into these. The ones where you have a rollover as business startup, which can result in 100% tax on your distribution from your IRA, and then you end up owing the federal government 130% of what you took out of your IRA. It's mostly just the accidental mistakes, right? You might have a foreign bank account, right, and not know that you have to be telling the U.S. government about it once if you are considered a U.S. resident, not for citizenship purposes, but you're going to be treated like one for tax purposes a lot of times, right? So if you come into the country and you may not know that account has $10,001 back home and is producing $2 of interest income a year, that the fact that you forgot to report that $2 of interest income is going to get you hit with a $15,000 penalty, right? $10,000 per year, so it could be $60,000. It's $10,000 per year failure to report, plus 50% of the maximum balance in the prior 6 years as you were required to report it. So it's not necessarily bad advice. It's just, you got to be certain that you're doing this comprehensive, those yes/no questions, the questionnaires that you're going to get from any accountant are going to be a big pain to fill out. But you better fill it out, because there's going to be things on there that you're never otherwise going to talk to your accountant about, and that helps flag it. So not a lot of bad recommendations out there. There's not a lot of really bad professionals, which is great. But there's accidental mistakes that can be just devastating.
Oversight.
Yeah.
Mm-hmm. And I think one thing I've heard from clients a lot is, I'm going to buy a house for the tax break.
Yeah,
Like
silly.
we already talked about that a little bit too, but I mean, there's lots of things you don't want to do for the tax break. Do it because you want to do it.
Do it because we want to do it, and if you get some tax benefits, that's a bonus.
Absolutely.
Getting married to save on taxes.
Okay, so usually I say no, but sometimes that is a good idea, right? If you have disparate incomes and you're gonna get married, you're gonna get married, and it's in January or February or March or April or May or June of the next year, and 100% you're not going to not get married, you know this unequivocally, you already consider yourself married, that's when I'll say get married for tax purposes and go down to the courthouse, sign the paper in December. Yeah, don't tell anybody. Just pretend like it's the first. Just don't tell your parents, don't tell your friends. This is just for taxes, right? It's just for taxes. It's meaningless because you're going to go do the wedding later, and that's when you're going to do the ceremony and
Sign the fake form.
Sign the fake form.
That's when you're going to celebrate your anniversary.
Yeah, exactly. And if you're getting married in a church, that's when you'll be married, like truly married. Who really cares about the stupid piece of paper that saved us $40,000 to pay for the wedding and the honeymoon and put another 20 grand into your investment account?
Disparate incomes. That's what he said.
Disparate incomes.
So kind of pivoting, a question we get a lot from doctors. Should doctors form business entities?
Maybe, right? It depends. That's
our favorite answer to every
question. All CPAs, that's our favorite answers. It depends. So there are a lot of things going on when you look at a business entity. And what are the types of business entities? We'll just say from the tax side, there is a sole proprietorship, right? That's just you. There is an S corporation, and from an S corporation, money goes to the S corp. You must pay yourself reasonable compensation. Reasonable compensation, in general, will be what would you have to pay someone else to do what you're doing, or what would you be hired to do, guaranteed salary from a hospital to do what you're doing. And everything else comes out payroll tax free, and that's truly the only tax savings of the S corporation is that payroll tax savings on those distributions. And the other entity, C corporation, not going to be the best fit. It's pretty rare that works out to be the best option. Extremely rare. There's also going to be a partnership, which again is not always going to be the best fit. It really you need set of facts and circumstances for that to be the absolute best fit. Perhaps you need a special allocation of profits or something like that. The other thing that in particular that we'd want our audience to look at is, okay, if I've got 10, when am I going to need an entity? I'm going to need an entity maybe if I've got 1099 income, right? If I'm an independent contractor, if I'm doing per diem work, or maybe I have my own business, one of the two. And in that case, if you have that per diem work, it's okay, well, how much do you have, right? And if we do an S election on this income, if we put an LLC in place and we do an S election on it, we're doing two things. One, we're adding costs because now we have a tax return that's very complicated. Just assume that it's going to cost $2,500 at a minimum to prepare that thing, $800 to run the payroll from a payroll company at a minimum. So we've already got this cost, we've got this break even that we need to exceed. And then it depends on, are we going to save on any FICA taxes? And if you're a doc, probably not. You're going to have a minimum salary that's likely going to be over the Social Security limit. And if you have another W-2 position, say you have $200,000 at 1099 and $60,000 of W-2, well, you don't get to take that other position's W-2 income into account when setting your reasonable compensation from the S corp. So you might end up having to blow that Social Security threshold, and then you're paying corporate Social Security tax that you wouldn't otherwise have to do. So just to give an example, let's say you have $130,000 W-2, you've maxed out Social Security. Now you have $300,000 of 1099 income. You have to pay yourself $200,000 at least in reasonable comp, right? You're going to pay yourself $200,000, and you're going to throw out about $7,000 in FICA tax that you otherwise wouldn't have had to have paid, right? So now we not only do we have the cost of prep, the cost of payroll, now we have this FICA tax waste. So that's a lot of what I see. And I also hear, a lot of what I hear is you're going to get all sorts of tax deductions if you have an S corporation. Not any more than you wouldn't already have if you didn't have the S corporation, right? It doesn't give you any more opportunities in general. And to make things even more complicated, now we have the qualified business income deduction. So if if you would have received a 20% deduction on 100% of that 1099 income, but now you're going to receive it only on the distributions from the S corporation, well, maybe we threw out, in the numbers that I just gave, maybe we threw out a $40,000 tax deduction that we would have gotten on those wages that we're now paying ourselves, right? So the gist of this is it's very, very complicated, right?
Mm-hmm.
And you need to run through your exact income streams with someone that knows all of these variables and can pick it apart and actually model it out, right? This is, you know, you can, for the most part, you know, anyone that is technically competent is going to be able to have a conversation and make a good recommendation. But there are those kind of bubble cases where you actually do have to model it out and determine how are we going to approach this. More importantly than just entity selection is just getting that retirement plan on those sources of funds, right?
Yeah, that's what I was just thinking.
Yeah, one of my favorites is, you know, if you have a $600,000 W-2, right, and you've got $100,000 of 1099 income, well, you know, we could just back to the napkin math, put 20 grand into a tax deductible avenue and put another 35,000 roughly into a mega backdoor Roth, right? It's pretty simple, pretty easy to do. If you have $60,000 W-2 and $100,000 of 1099, we might decide, okay, well, best for you is, if possible, if cash flow allows, $55,000 mega backdoor Roth and nothing in pre-tax, right? It just depends. If you have $300,000 W-2, $300,000 of 1099, maybe we want to do a defined benefit cash balance plan and get a $250,000 deduction. Unless if you're towards the tail end of your career, if you're at the start, then based on age, it's probably half that. It just really depends. It's all unique. It's all different for every single person. There are generalities, of course. But there's not going to be some big matrix that I can provide you or point you to where you can say, this is where I fit right here. It's all going to be based on the knowledge and expertise of the team that you've assembled.
And for that retirement piece, so, you know, a lot of people are familiar with, I can do 6,000 to an IRA, 19,500 to a 401k as an employee. But as a business owner or as an independent contractor, that 401k limit, you could set one up for yourself and put, I guess in 2020, what is it, 57,000 in total, plus an extra 7 or 6 if you're over the age of 50.
Correct.
Plus potentially set up a cash balance pension plan or potentially do the mega backdoor. So you could stuff a lot of money into a tax favorable account, provided you have the cash flow.
And now I with the cash balance plans, 250 is not even right. That was a couple years ago number. Now it's like 300 something.
Depends on your age.
Yeah, depending on your age. I just saw an illustration come through. Oh, 330 grand. I like that number. When did they do that? That's awesome. Congress has someone that's making some 1099 income.
Speaking tours.
Yeah.
Yeah.
Yeah, defined benefit plans.
So I mean, we could spend hours talking about tax strategies for business owners, you know, and probably we'll do a separate podcast just on that. But maybe what are a couple quick highlights? If you're a business owner, you own your own practice, you know, what are some of the just no-brainers that you should be aware of or doing?
It goes back to number one, make sure that you have books and records, and at minimum, say that you have a very simple practice and meaning, you know, you've got money coming in and not a lot of expenses going out. At minimum, you need to have that all run through one single bank account. I mean, even your credit card charges, have a corporate account, a card, if you want to get those rewards on it, right? That's why you want to run some expenses through that. Still be very diligent about running business expenses through a business account so that you don't lose those transactions. Or be very diligent of recording every single expense that you receive, and make sure that when you get your 1099, that the income that they tell you that they gave you is the income that you received, because it's someone that is likely making $15 an hour doing a few thousand few tens of thousands of 1099s at the end of the year, and I've had many times where it doesn't match, right?
It doesn't match the paycheck.
It doesn't match, and you don't want to overpay because you didn't validate that the amount that they're reporting is correct, and you don't want to miss tax deductible expenses because you failed to provide them. So that's number one. Goes back to the beginning of the conversation. Organization. Be organized, right? Come up with a system that works for you. That system could be as simple as run it all through a bank statement at the end of the year, throw it at your accountant and say, figure it out, right? That's the worst one, but it is one. And if it works for you, that's okay. The best one is, diligently tracking and recording and making sure that you are aware of what's going on. I say that, but we've got a wonderful admin staff here, and I just, she does all of it. We just throw the expenses at her. She does all the things, and we might be accountants, but we're not tracking that either. But I'm making sure every time I run that card, if it's not going through the business account, there is an expense being recorded somewhere.
Absolutely.
So
there's so many things to think about as business owners that you just don't have to think about as W-2 employees.
yes.
Do you have people come to you asking, what's better? Should I be taking a W-2 job or should I do this 1099 job? Do you ever have this conversation with clients?
Absolutely.
Yeah.
Absolutely.
No, we
And-
do a lot.
Yeah, and the two things that I would suggest is one, look at the payroll tax ramifications, because if I'm going to go very simple here, right? If you are looking at a $200,000 W-2 position versus exactly $200,000 of 1099, they would have otherwise been paying half of all the payroll taxes, right? So if you get gross W-2, 200,000, or a 1099 of 200,000. It's 6.2 FICA tax that they would have been paying up to around 130,000, and 1.45% Medicare tax on the entire amount. So let's say that's $10,000, right? So that W-2 position could actually be $10,000 more in your pocket if you took it. On the flip side, maybe they don't have benefits, maybe they don't have retirement plan, maybe they don't even have health, right? And if you had that 1099 stream of income, certainly, I'll tell you right now, if you were going to get W-2 of 200 or 1099 anywhere close to that, your reasonable comp is all of your monies, right? So you're not going to do an S corporation. You're going to be a sole proprietor, or you're going to talk to your attorney. Maybe they're going to recommend that you have an entity in place. We're still going to be, if we can, if we're not in California in general, we're still going to be a disregarded entity. Now, am I going to give up $10,000 of permanent tax savings to receive a $30,000 potential? Let's just say I was going to get a $30,000 retirement plan. That's what I was going to, if that's the amount that I was going to give into my retirement plan. Or let's say I was going to do, I'm going to max it out. I'm going to do $55,000, right? That $55,000 tax deduction translates, let's call it into, I don't do math in my head, but let's just say it translates into 30% of 55,000. Let's go 17.5-ish. So $17,000 of temporary tax savings in exchange for $10,000 of permanent tax. And what I mean there is that that payroll tax is a permanent tax. You're never getting it back, right? If you pay it, you pay it. Maybe you get it back from Social Security. There's an argument there, but let's ignore that. Because I can quantify, no matter what, either way, you're going to get that Social Security back, right? I can quantify that even though you get this temporary tax savings from deferring the money, eventually someone's going to pay income tax on that 401k dollar, right? So I will always look at the marginal spread between my temporary savings and my permanent savings, and that's my true tax savings. So instead of 30% in this we're looking at a 20% tax savings, and in that we won't even put a retirement plan in place. then we would choose the W-2 position. So that's just, and again, it's super unique, facts and circumstances. What are the numbers? What are we talking about?
What are
What
the
is your
benefits
cash?
of your
What are the
employer?
benefits? What is the cash flow? What can you actually save, right? So it all depends.
It's our favorite answer.
Yeah, so kind of pivoting here to one of a favorite thing that docs like to maybe, I'll use the word dabble into, but that's real estate and rental properties.
Yes.
What are some, another one we could spend a whole episode on, but what are some tax implications that they should be aware of and common tax mistakes around handling rental properties?
So I'm going to start the conversation out by just saying know how to calculate a cap rate, right? In real estate, they call it the capitalization rate, the cap
what
rate,
it is,
return on
Google it.
investment. Yeah, agree with that. So know how to calculate that and make sure it is a good investment before you get into it. And then when you do get into it, make sure that that you're getting the depreciation expense right? That's, I see a lot of that go awry, right? So residential rental, you're going to have the land, don't get any expense on that. That just kind of sits there. The building is going to expense over 27 and a half years because Congress tells us that after 27 and a half years, it's going to be worth nothing. And then if you have shorter life property, say carpets, a fence, landscape improvements, that might be 5, 7, or 15-year property contained within that. And you can rip the value of that out of your purchase price as well. Maybe it qualifies for bonus depreciation and you get to immediately expense it so that you're kind of accelerating the tax deductions now. And that gets really important the larger of real estate investments that you get into, right? A commercial building that costs $1 million is going to have a lot more opportunity to capture immediate expense than a rental property. There's also going to be, rentals are not easy, right? The rental rules are not easy. They're not straightforward. In general, you're probably going to qualify for the qualified business expense deduction. That's new and that's not well understood right now. But there are safe harbors which allow you to qualify and not be questioned by the IRS. A safe harbor is something where the IRS says, if you do these steps, and this is littered throughout regulations on taxes, if you do these steps, we will not question your answer. We will allow you to do it. You don't have to meet the facts and circumstances test. We are not going to attack you on this. If you do these baseline things, we have rubber stamped the transaction or rubber stamped the position that has been taken on this this tax strategy or tax position rather. So with the rentals in general, just making sure that it goes back to books and records. Right? If you don't know about it, then you can't deduct it. And we've seen some really funny things over the years, fat keying numbers and claimed $100,000 insurance expense on the rental property, right? That didn't happen. It was 100. Only 100, not 100,000. So also where the rental property, the I've seen this also. Doc was treated as a real estate professional, so deducted all of the rental losses from that property because depreciation expense. It's a paper loss. It's not a real loss. It's a paper loss. There's no cash flow associated with it. Deducted all of that against the W-2 income, and you can't unless you meet specific facts and circumstances, right? And a real estate professional has to have a lot of hours, and you got to be able to prove all those hours. It's like $750 based off my memory. Don't hold me to that, but let's just call it 750 hours, I believe it is. You're not going to be working on your little rental property 750 hours a year, right? That's a lot of hours. So you're not going to be able to deduct those because they're going to get caught up in what are called the passive activity losses, right? So while it can't offset your other sources of income, it can offset other sources of rental passive activity in general. rental passive activity income. So if you have multiple rental properties, you can have some ones that are producing some losses that are offsetting gains of other investment properties. That doesn't mean that you lose that net operating loss of that year. It just means that it carries forward, and it's either going to offset future income, or when you sell the property, it's going to offset some of the gain that's calculated at that time.
So just to clarify here, if you have a property that's cash flow negative, and we'll see this a lot with someone who moves from their starter home to their dream home, and they can't sell the starter home for what they want, so they turn it into a rental. Maybe it's costing $2,000 a month, but they're renting it for $1,500 a month. That $500 loss, is that deductible off of their W-2 income when they do their taxes?
Almost, but it's not going to be that $500, right? Because that $500 is going to include a principal amount on the repayment of that mortgage, right? So if you have a 15-year, let's just say you have a 15-year mortgage and you're paying it off fast, you might be negative cash flow but positive income. On the flip side, if you've got a 30-year mortgage, you're likely going to have a loss on that rental property. It's going to be your $2,000 negative, or your $500 a month negative amount, plus your depreciation expense, non-cash depreciation expense, minus the principal that you paid, essentially minus out any out-of-pocket costs. That's going to be what your tax loss is. So not super easy to calculate, but in general, if you're not cash flowing, you're probably losing money. Probably.
Yeah.
So
you can potentially lower your W-2 tax bill a little.
Yeah, and that's the other part of this, is that any tax person that listens to this podcast will find something different than what I said. And one thing different is I'm speaking in generalities, and at a certain level of income, under that level of income, roughly $150,000, then you can deduct those passive activity losses in general up to 25 grand against your other W-2 sources of income. So again, it just goes back to it's really complicated for every single person, right?
Depends on the specifics.
Depends on the specifics, and Congress told us that they just redesigned taxes in 2019, and for 2018. And it was so easy, anybody could file a tax return on postcard, right, for 2018. I don't know about everybody else listening to this, but that was miserable.
They made the form the size of a postcard.
They made the form the size of the postcard, and they added 6 schedules and threw everything behind. The great thing is this year we don't have that anymore. They got rid of the postcard because they realized that it was silly. Taxes were not simplified. They were made incredibly more complex. And the few folks that they were simplified are, if you have a W-2 and not much else, yeah, it got a little bit simpler. But that's it.
There's so much going on here. So when you have some people that have a lower income and they can basically fill out their taxes on a postcard, maybe talking to a CPA isn't necessary, or I don't know, maybe that's not the best way for them to pursue filing their taxes, but at what point do you think it is important for people to be seeking out professional help?
Yeah, I ask all prospective clients to essentially run a 2-pronged test, and that first one is, are you going to make a mistake? You don't know if you're going to make a mistake, but you're going to get an honest answer when you say, hey, this is what I have going on, take a look, quick look. And based on that conversation, you're going to be able to get a response which is either yes or no, right? And if you're going to make a mistake, or you're starting to get into types of transactions where it's not what you do, you shouldn't be doing it anymore, right? Just as an example, if you have a rental property, yeah, you can do it on your own, but should you be doing it on your own? No. If you're doing a backdoor Roth conversion, can you do it on your own? Yes, but should you be doing it on your own? No. So then it's just finding the right fit for you at that point. The second one that I find is also a good kind of bellwether of whether you should hire someone or not is it's does the pain of paying someone, is it less than the pain of doing it on your own?
I love that one.
Yeah, and I have a lot of clients that, yeah, technically, like, you can do your own return, but they don't want to do their own return, and that's okay. That's what I'm here for. When you have a team that works really closely together, it just makes it a lot easier for those clients that just want to do doctoring. Right?
Absolutely.
I'm not going to perform surgery on myself, and every time I WebMD myself, my doctor says, Ryan, turn off the internet. I'm just going to shut it off for you. You're not allowed to diagnose yourself ever again. You don't have diabetes. Just sit upright in your chair. Right? So that would be my recommendation, that 2-prong test.
Yeah, I do feel like that's an appropriate test for a lot of areas of your life.
Yeah.
Like, do you want to clean your house, or would you? Is it worth it for you to pay someone else to do it?
Yeah. Yeah.
But I'm sure there's some people that find the pain of paying someone else more extreme
Yeah.
than doing it themselves,
Absolutely.
and they're torturing themselves.
I really enjoy doing
Hours on
some
end.
of our yard work. My wife really enjoys mowing our lawn, right? Neither of us enjoy edging or weeding, so we have someone do the edging and the weeding. So it's all about balance.
Yes, maybe to wrap things up here, save the best for last, but retirees, if there are any retirees listening to this, I know there's a couple that of my clients that regularly do,
Yeah.
but any tips for people in retirement to potentially minimize tax liabilities in addition to it depends?
Yeah, so this kind of goes back earlier in the conversation where I mentioned it's not just your taxes, but it's your beneficiaries' taxes, right? So that's where we're really designing and should be specifically saying, okay, where are my income streams? Where do I have to take out of? Where am I at right now? If I pull from more IRA money, is that going to screw up my taxability and Social Security? Am I in this little year of time where I've maybe got quite a bit of Social Security and zero taxable? And if I pull in more income, it's going to be 85% taxable. Or can I do active reallocation of capital gains? Can I harvest capital gains at 0%? It just depends on how much wealth is there when you're retired. And at that point, the strategy becomes completely different. Because if I'm just going to give an example, if you have $1.5 million in a 401k or a traditional IRA, and you're getting Social Security and you have $100,000 in it, we're probably going to be recommending just minimizing taxes, right? And we're just going to take out kind of what we need every year to live off of, take off what we need every year to live off of, and call that good, likely. If you have $20 million in investable assets and taxable accounts, and you've got $10 million in a traditional IRA, and you've got Social Security, the Social Security doesn't even become part of the conversation, right? At that point, we are taking out as much from that traditional IRA and converting it into a Roth. We're still living off, we're not pulling it out to live off of, right? We're pulling money out of the taxable accounts with low basis, not triggering, or with high basis rather, not triggering capital gains, and we're doing this for our kids because there was a legislation in the works, and I believe it may have passed or is going to pass, where those retirement accounts, when they get inherited, instead of doing that old methodology where it can come out over 30, 40 years, you're taking everything out over 10 years. So if you give your kids $1 million 401k, they've got $100,000 in income a year for 10 years when they
Added on top of their own income.
Yeah, and if they're anything like my grandma, you know, a lot of retirees, and maybe this is you, audience, maybe it's not, but my grandma in particular would complain every year, tell me to go back and sharpen my pencil. She didn't want to pay that $100 in tax. She wants to pay zero. Be like, you've got all this income, like you just went over the threshold, and like you've got all this money in the account, just start spending it. I don't want to spend it. That's for my kids. All this interest, all this growth, that's all for my kids. No, but everybody wants you to spend it, right? Just go spend it. But it's that idea that, hey, yeah, but let's do these other things like cash and annuities and harvest that income in years where we have low taxes or high medical expenses to just offset things.
Right.
So thinking about not just how do I pay the least amount of tax always forever, but how do I make this best for where I want the money to go? Because it's I'm not a big fan of the approach of it's my kid's problem. Once they have the money, they can deal with the tax. Mm-hmm. Because there's a better way to do it, right? Especially when it comes to estate planning. If you have any sort of semblance of a taxable estate, you better be talking to your tax attorney and your CPA and your family so that everybody knows what's going on outside of the scope of this. But I'm sure that everybody knows that if you've got kids that are going to inherit quite a bit of wealth, you should be training them for years and years on how to deal with that, mm-hmm. how to manage that, so that it's still there for their kids.
Make them tag along to meetings with your financial advisor,
yes.
your CPA, and your attorney.
Yep, absolutely.
Well, this was awesome. Thanks for taking the time. We'll probably steal you for another one.
Absolutely.
There's plenty of other topics to dive into.
More specifics. Mm-hmm.
Yeah. So if you want to get in touch with Ryan, either reach out to us or you can visit thefinitygroup.com and check out our tax page. And best of luck with taxes.
We would love to hear your feedback and suggestions for future topics you'd like us to cover. You can get in touch with the show by emailing podcast@thefinitygroup.com or by following Finity Group on Facebook, Twitter, and LinkedIn at Finity Group LLC.
You can follow me on Twitter at Corey Janoff CFP or on LinkedIn under my name, Corey Janoff.
You can follow me on Twitter at Rochelle Finance or on LinkedIn as well.
Check out all of the podcast episodes on thefinitygroup.com/podcast or wherever you get your podcasts. And don't forget to check out our blog, thefinitygroup.com/blog. Thanks for listening to this episode of Financial Clarity for Doctors by Finity Group LLC.